The dollar index, the main one being the DXY, has continued to weaken. Getting the direction of the dollar correct will be one of the most important investment decisions for all investors over the next few years. In this week's big conversation, I'm talking to Julian Brigden of MI2 Partners and Macro Insiders about why he thinks that the structural peak for the dollar is now in place. In recent weeks, US dollar bulls like myself have been sent scuttling back into the shadows. On returning from vacation, I found some of the structurally bearish narrative was starting to reach an extreme level. And when I looked at this weakness in the US dollar, most people were really talking about the DXY, which has had a dramatic move lower in recent weeks. But the DXY is 58% euro. The British pound, Swedish krona and Swiss franc make up about another 20%. So this is basically an index of European currencies plus Japanese yen and Canadian dollar. So is what we're seeing really US dollar weakness, or is it euro strength? Challenging our own market framework is a key element of investing. Julian Brigden, who's been trading and analysing currencies for over 2 decades, has a bearish case for the US dollar. And I wanted to find out from him whether this was structural or cyclical, and what he thinks are the key drivers. Julian, welcome to the big conversation.
Hello, Roger. How are you?
I'm very well indeed, thank you. Very well. Very glad to have you on, because I wanted to get some of your views on the dollar. Because obviously the dollar, if you get the dollar right, you probably get a good portion of your portfolio right, and obviously vice versa. And I think with over the last 2 or 3 weeks, really everyone's been talking about gold, silver, and the dollar. Obviously they're connected, but dollar is such an absolutely important element for all of this. So I really want to just go back a little bit, because I think you started to change your view on the dollar from kind of a sort of bullish, maybe more neutral view towards being a little more bearish at the end of last year. Could you just go through that process, the end of last year, beginning of this year, and then kind of go through, because I think the key thing here is that your view is much more structural now than it is necessarily cyclical.
Right. So Macro Insider clients will know that Raoul and I, there was a long period of time where Raoul and I were very, very bullish. Particularly in sort of 18 into early 19, when a lot of our peers around the world were starting to be dollar bears, and we were both decidedly bullish. And then I kind of got bored, frankly, if only because I thought, certainly versus the majors, which is the thing that most people can trade liquidly. I mean, you can do EM, obviously, but it's not easy for, say, the Macro Insider crowd. We turned less interested. Let's put it like that, Roger. And then as we moved into the end of the year, we started to see the stars aligned. And we were looking for this, frankly, because dollar cycles are tremendously predictable in terms of both length of time and amplitude. We were looking for kind of that turn. So the first piece we wrote to the MI2 clients was in October. We raised the question, could we be coming to the end of the dollar cycle? And just kind of get your head around the idea, the concept, could this be changing? The big thing that we were missing was the final sort of et tu brute move in a dollar rally. And a dollar rally is very destructive. That's why I call it the et tu brute kind of move. And that is the risk off dollar rally. Now, euphemistically, and it's a term that quite a few people in the market have picked up on, we call that the napalm run. And it typically happens when the Fed pushes policy too far, or we get excessive dollar tightness, and you get a dollar rally in a risk-off environment. So stocks are falling and the dollar is shooting higher. And that is ultimately doubly toxic, because it's the denominator of most risk assets. So you get this really accelerative move. The good news is that typically marks the zenith of the move. At that point, not only does the Fed do a mea culpa and say, sorry, guys, we've pushed this too far, which is the first one they did in early 16, where, China had devalued and so on and so forth. But then it truly initiates an utter reversal of policy, Roger. And I think that's, when you look at COVID, you look at the monetary response to COVID, you look at the Fed's response to potential fiscal spending. This is a 180-degree reversal in policy. Gone at any conceptual ideas about tightening. Now we're talking essentially full-on MMT. And to my mind, that marks the high. And then when you look at things technically, we've broken 2 of the big trend lines that we like in broad dollar terms. So yeah, we think the dollar is breaking. I mean, look, we've come to some big levels. These are big levels. We had a nice run. Could you get a tactical, retracement potentially. But when I look at it next year, I just see a US that's just going to push its exorbitant privilege to the point of breaking point as it tries to sort of push more and more spending into the domestic economy, an economy which I think will be weaker than its peers. And in a way, in that sense, what the US is doing, it's the gap between Europe and the US is converging, but the wrong way. It's not Europe getting its act together. It's the US ending up down that kind of Europeanized route.
And do you think, within all of this, and there's, the dollar bulls are obviously kind of a little bit sort of licking their wounds at the moment, and obviously the dollar bears are in the ascendancy. But almost, coming back from 2 weeks on holiday, there's almost a sort of bearish hysteria going on. And so I looked at it, and it felt a little bit more like this last move, particularly the last 2 or 3 weeks, was less dollar weakness, more euro strength. And it was the euro strength. You also had Swedish krona, Norwegian krona, Swiss franc, sterling. So it's Europe and other European currencies moving higher. Because when I did the comparison of the JP Morgan Emerging Market Currency Index versus the DXY, which is about 85% Europe and a little bit of the yen, it really is Europe that's been moving, because these emerging market currencies are only about 4% off their lows versus the dollar.
Right.
When you look at things like Canada, so Canadian dollar, Mexican peso, the biggest trade partners, again, they've obviously moved from the dollar high of March, but they haven't regained the levels that they were at prior to March, and certainly not at the beginning of the year. Isn't this really a euro story that's developed since that 750 billion package was confirmed in the middle of July, when we've had this leg from 112 to 118 on the euro? So isn't this a euro story, not a dollar story?
Roger, you raise a very interesting point, right? I call this more a sort of DM versus EM story, and I think there was some solid fundamental rationale for that. So what we've seen is a normalization and, should we say, a reversal of the funding squeeze that we got in March in most of these DM currencies, and they've come back to levels from whence they started back in January and February. They haven't really broken. So even if you look at the euro, you look at a chart of a closing chart on a monthly basis of the euro from the highs in 08, we're kind of pushing that level, but it's halfway through the month, and maybe we're peaking a little head above it, but let's see where the month closes. But I generally think that EM has performed less well. I think there are some structural problems there. I'm hoping that as this dollar weakness starts to manifest itself next year, early next year, and we get a macro story in terms of the virus, and I'm not so negative on the virus. I'm actually reasonably upbeat on the virus. I think it's being blown a little bit out of proportion here with this, what I call sort of project fear from the media and the politicians. That as we start to see that kind of growth value rotation, essentially, some of the EM will catch up. But I think there's also a structural reason why we potentially have a problem or a divergence. One of them is that EM borrows in dollars, right? And we do know that there's a lot of outstanding dollar borrowing going on there. Raoul's pushed that story very strongly, sort of 12 trillion. Whereas DM doesn't really borrow in US dollars. What DM does is typically invest in the US, because they're the countries that are funding, along with China, the US current account deficit. So they hold US assets. And one of the reasons why I'm increasingly bearish, and it goes back to this European-US convergence, is that we've lost a lot of the sexiness that comes with investing in the United States, particularly in the rates market, right? If you look at the interest rate differential between euros and dollars, that has collapsed. It's collapsed the wrong way, though, right? US yields have collapsed towards European yields. There's still a big momentum trade going on in US equities, and in particular US growth stocks. But I think even that could get challenged next year if we do see this economic recovery and a peaking of COVID. And I've heard from numerous very large real money investors that when you look at the US and you look at 60 basis points of carry in a 10-year treasury unhedged in a country that is going to push its luck in terms of deficits and issuance, it's just not a very sexy, attractive place to be. And so I think it's more the question that you could get DM investors either taking some profit on those, and the money involved in that is double the borrowing of EM. Roger. I mean, if you look at liquid US securities held by foreigners, it's like 22 trillion. If some of that money just decides, hey, I've had a good run in Amazon, or hey, I don't want to buy US treasuries at 60 basis points, then that metric, which has created a lot of what we would refer to as sort of US exceptionism. So strong dollar, I go and buy US assets because the dollar's going up as a foreigner, and it becomes a self-reinforcing, true Soros-esque reflexive cycle, reverses.
Yeah. And do you think, I mean, one of the elements within all of this, I guess, is the, because we've talked about the fiscal, and, you mentioned the fiscal in the US, but every country's doing this. I mean, Japan's doing it, Europe's doing it. And it's this sort of strange world, because a lot of people say, well, more fiscal should weaken your currency, which sort of theoretically it should. But it seems that Europe was rewarded with a premium into the euro because they managed to get their act together. So their fiscal injection was a positive. The US is seen as a negative. But there comes a point, doesn't there, where Europe will start to squeal, because already we can see in this last leg of euro strength, we've seen significant underperformance of European versus US equities once again. It's an exporting bloc. I think 70% of the equity market in Europe is based on exporters. And they're not just exporters within the Eurozone, they're often exporters out. So doesn't it get to the point where, I think Draghi was always around about the 120, 125 level where he started stepping on the gas again. And we can also see back from 2014, if Europe or Japan want to step on the gas, they can impact their currency much more quickly than the US. So isn't it actually a self-regulating mechanism that we're getting to the point now where Europe will need to do something in order to prevent the euro strengthening, which means they'll never get the inflation that they need to make things better?
Yes, look, this is always it's always a merry dance, right? It's two steps one way, one step back the other. And I would agree with you. I think if you get into the low 120s, you should expect some pushback. I mean, my sort of target on the dollar index is around, 88, kind of the lows from 2018. And at that point, I would expect some kind of response. But when I look at this kind of bigger picture, there's a couple of things that I would say. The first thing is that the United States, I think, is going to have a very different policy mix on the margins. So firstly, I would agree with you. I think Europe is spending a little bit more money. That's being positively rewarded. But it isn't going to spend, I don't think, anywhere close to what the United States is going to spend. And I think in part that's to do with coming into a new election cycle. I think that we've seen socially here every single reason to really push the boat out in terms of spending to address social inequalities, Black Lives Matter, all of these sort of things. And if certainly you get a Democratic administration, although I don't think a Trump administration will be that much more fiscally sound, you're going to get an awful lot of excuses to spend, Roger. And I think Europe isn't going to spend as much, right? We know the Germans are never ultimately going to allow that to happen. The second thing is that the ECB is never going to quite go down the route that I think the Fed is going down in terms of the inflation mandate, right? They cannot, this is a Fed that is pretty determined to say, we're going to let this thing run hot. The ECB can dance around that nuance, but unless they want the German Constitutional Court jumping up and down on their throat saying, you're abandoning your inflation mandate, that's kind of harder to do. And so what I think you end up in the United States is actually the worst combo on a relative basis for a currency. That is extremely loose fiscal policy and loose monetary policy. Because I don't think even the bond market is going to be allowed to price in the premium necessary to fund those ongoing deficits. And so I think, because I think we're going to have some sort of yield curve control de facto or not. And so I can see a situation where the Fed ends up being essentially the buyer of last resort for the Treasury market and ends up with its situation on a relative basis. Not to GDP, I know we talked about that, but just absolutely on a size basis, the Fed's balance sheet blows out more than its peers. And the other thing I would say is, look, at this point of the cycle, yes, a strong euro, let's put it, a weak dollar is perceived to be bad news for Europe. But let's get on ahead, a year down the line, and let's say that a weak dollar has started to encourage some commodity market strength, right? One of Europe's major exporting markets is EM, right? They're hugely exposed to EM. And if their markets are starting to do better, I think they can take a marginally higher dollar in terms of selling BMWs here in the US.
But do you think on that, I guess the inflation, reflation story, because are we talking here inflation or reflation? Now, I know we're going to see fiscal expenditure and, every government on earth is going to be doing this. And so when I look at that, I guess, as the balancing out, which is the US will do the most on a relative basis, but combine all the others together, they're still going to be much.
They're all doing it. Right.
But then isn't this what we're talking about here is suppression of yield? So, the yield curve control, I think, is absolutely guaranteed. So we're not going to see long dated yield. Maybe the 30-year can go, but the 10-year, let's say, they won't allow it to get to the point which becomes painful. But inflation probably can tick up. Don't we just get inflation and not growth? What we want is wage growth, because it's wage growth that impacts debts. But what if we just get commodity inflation, just pure old bad inflation, so we get stagflation and not reflation?
Well, look, I mean, yes, you're right. Ultimately, what you're really aiming for is high nominal GDP growth. So you want strong underlying real GDP growth plus a little bit inflation. Let's be honest, at the end of the day, they would rather have the higher growth element within that equation, but screw it. If they can't, they'll take the inflation bit and they'll tell you, don't worry, we've got your back. This is just a short-term overshoot. We're just letting it run a little hot. And I think the mix will change. I mean, I do think fiscal policy, and this is the big change that I've had in terms of the inflation story. I think that fiscal policy is tremendously powerful in creating inflation, particularly, should we say, nationalistically orientated fiscal policy at the time when we're seeing deglobalization, where we're seeing potentially more onshoring, all those sorts of factors, which are on the margin just remove some of the efficiency from the global economy, which is add to that disinflationary forces. I think we are going to see our models tell us basically that certainly when it comes to headline CPI, which is what we kind of trade in the market, that's what was priced into break evens and tips, that is going a lot higher by next summer. It'll dip into Q4 quite sharply. If you do get any sort of dip in break evens, tips, whatever, close your, and gold or silver, close your eyes and just buy that dip. I think next year we're going to be at CPI at 275, 250, 275. Where we go after that is more a function of what the dollar does, because certainly in the United States, and actually globally as well, because commodities tend to outperform in absolute terms, so they were going up even in euro terms, Roger, that will determine where that inflation picture goes next. But I think as the fiscal spending comes through, it's quite inflationary. We saw that under Trump. This spending that we got in 17 and 18, that fiscal spending, when that really kicked in, inflation, CPI in the US should have been a hell of a lot lower than 2 and change, given how strong the dollar was, given that historical correlation, but it wasn't. And I think that's a testimony to power of fiscal spending. So I'm much more in that kind of, there's a mechanical rise in inflation coming, but if we are truly breaking down this dollar 10-year, decade-long rally, you should be more orientated toward that inflation story. It won't come through. If you look at the late 60s, which is a model I've kind of been using, it took you 5 years to go from 1.6 to 6. Okay, that's a long time in market terms, right? We can end our career 5 times a year if you get the trade wrong. So I think you've got to get perspective. You've got to, like I said, the euro's coming up to some big levels. Maybe it goes from 118.5 back down to 116 or something, and everyone goes, "Oh, it's never gonna, the dollar is never gonna rally." But that's just a blink.
With the fiscal side, it's a vast amount of fiscal expenditure, but in many ways, what they're actually doing is they're filling a hole. So you talk about fiscal in 2016, that was additive. So therefore, it could be inflationary. But is the fiscal that we're seeing at the moment additive, or is it equalizing, or is it not actually filling the hole? And the talk is that if you don't get sufficient rolling of furlough in the first place, we get the wave of bankruptcies potentially. We get the wave of insolvencies. So isn't there a risk that we've actually got the final napalm run to come, because we still have that insolvency risk ahead of us? Or do you think that we are in QE infinity, therefore we're in fiscal infinity, therefore they will just keep on going and going and going?
Yeah, it's the latter. I mean, I think they've look, they were insanely quick to cap out that napalm run. I mean, if you'd have asked me in October, look, Julian, we're going to have the risk-off dollar rally, the napalm run, I'd have gone, yeah, that's kind of how it ends. How quickly do you think the Fed will respond? Well, they'll have done everything that it took them a year to do in the global financial crisis. They'll have done it in a week, and then they'll have gone way beyond that within 2 weeks. I'd have said, no way. I think they're highly cognizant of the risks of a stronger dollar. I don't think they want to see that. I think if we were to get it again, they would be pretty quick to cap it out. I do think the fiscal spending, I would agree with you, Roger. I think thus far, the fiscal spending and even the monetary easing that we've seen so far has not really been net additive. At the most, I look at our models for sort of effective Fed funds, and they really haven't eased at all. So in that sense, the Fed is actually right when they say all we have done in terms of the expansion of the balance sheet thus far is offset the negative that was caused by the March self. We haven't taken things any further. So if you kind of look at a shadow Fed funds model, right, you can say, well, bond yields are a hell of a lot lower, and they are. Okay, that's the one element that is. The S&P actually isn't higher than where it was in February. The dollar isn't actually lower than where it was in February. Fed funds haven't changed. So net, there's not that much easing that the monetary authorities have done. On the fiscal side, I'm not overly optimistic that we're going to get a fiscal deal here in the US. I'd put the odds at somewhat 50-50. I think it's a lot harder in an election year to actually craft a deal than it is in a normal year, because neither side wants to be seen to be giving ground. So I think next year is when we I think the Fed will come in and will announce a program of QE starting in probably October, then it's in September. So that's another wave to come through. They do need to do more, as I've just said. But I think the big story is next year when you get a new administration, a new narrative of kind of, almost like a Johnson-esque Great Society kind of spending program, particularly under the Dems. I think they'll craft that in that sort of terms. And I think that's when you'll really see the story kind of develop. At this point, look, I'm a bear on the dollar. We've had a good run. Do I sell any rally in the dollar? Yes, I do. Do I really think as I said, 88 on the dollar index is kind of my initial target. It's that low 120s where the ECB comes and bitches. Maybe that leaves us till next spring, right? Then I think we start to see things really develop.
And with the kind of the bonds and inflation, it's going to be a bit of a conundrum, because normally, one of the things that is impacts markets is if you get the inflation expectations changing, usually bond yields follow that. But if we assume yield curve control, we could obviously get not necessarily rampant inflation, but inflation going to the top end of the range, that percent level, whilst yields maybe are held around 1%.
Yeah.
We saw this in the end of 2018, 3.25 on the 10-year blew the equity market up.
Right.
We don't get that. Can inflation on its own blow the equity market up, or is it yields and the actual market cost of capital rather than the cost of goods and services? Can the goods and services impact it, or is it that the fiscal, the monetary, means that risk assets remain elevated even if inflation goes beyond expectation?
Look, if you look at the late 60s, what you find, and they didn't have yield curve control, but they, in a way, they had de facto yield curve control, not for the Fed, but actually the market self-regulated. And the problem is whenever bond yields rose a lot, so as inflation went from 1.6 to 6, bond yields went from 4 to 8. Okay, but if you look at it in real yield terms, they actually fell quite a lot, and till the very end of that period where they spiked. And the reason is the bond market kind of self-regulates, Roger. Yields can't rise enough, because if they rise enough, they clatter the equity market, and then you kind of get into that vicious circle that you're in. So I think it's unrealistic, even given, let's say there isn't yield curve control, which I think we both agree there will be of some way, shape or form, to assume that the bond market can truly price itself to where it should be. I just don't see that. So I do see an environment where risk assets do exceptionally well. I think the question is which risk assets. So if I see a risk to the US equity market, it is that we have very high concentration, as we know, in half a dozen stocks. Goldman have come out with a great stat, a 10% correction in the big six to keep the S&P flat would require the bottom 100 of the S&P to rally 90%, right? So it's, I think the issue is if we do get more QE, fiscal spending, a peak on the virus, early next year, as we realize we've got through the winter, we haven't had the deaths and the hospitalizations. Maybe we're through the worst of it for whatever reason. We have greater herd immunity than people think, which I think is one definite reason. The virus is mutated to become less virulent. We have a vaccine. That's actually when I think the US equity market probably starts to underperform because we try and take money out of Apple and Amazon, which are trading at ridiculous PEs, and buy cheap value. And value's not the US. I mean, there are certain stocks within the US that are value, but value is EM, Europe, Asia, right? That's value.
And then just sort of finishing it off now, as we sort of get to the end of our time, but the biggest consensus trade is that equity trade in terms of popularity. But the second biggest is one that it feels that in this environment will continue, which is it's a consensus trade, which is being long gold, long precious metals. But we're talking about higher inflation, capped yields, so therefore real yields.
The opportunity cost of holding them at low,
real yields going down, dollar falling. I mean, that means that although it's a consensus that the institutions aren't in on really yet. And obviously Buffett was talking about this, but it seems that although we talked about it on the big conversation, gold and silver look like they probably have a lot more to go because these ducks continue to line up. Yeah.
I mean, look, you listen to us on Macro Insiders, Raoul and I. I mean, this has been very much a consensus trade. I mean, we started to buy precious metals back in the spring of 2019. We had a good run up. We kept the gold. We got stopped out of a silver trade for a big profit. We then re-entered back in March, right, at $12.62. We told people to go buy silver. And it's been, better to be lucky than smart, as they say. But it was our kind of bet that this would be the better trade than equities, to be honest. I still think that's the case. I mean, I do stress to people that, this is not a hedge. A silver with a realized 1 month volatility of over 80% is not a hedge to your portfolio. It is adding an awful lot of nitroglycerine to your portfolio. But I think if you can stomach the vol and you have it as a sensible part of the overall portfolio, I think I'm very excited by silver. I mean, I started off trading silver. It's the first instrument that I traded as an entrance into financial markets at Salomon Brothers, and I sold vol at 110% in the run up to an extreme high. This is a super high beta dollar precious metal trade. I think when you look at it and this goes back to kind of it's the inverse side of this concentration in the US mega caps. We're going to find, I think, as we try to take money out of the mega caps and put them into other stocks, some of these other stocks are going to move disproportionately because just the liquidity mismatch. What we're finding now is how far these precious metals can move in a market where you try and take 2 or 3 or 4% out of the global sovereign bond markets and stick it in precious metals. Good luck, frankly. Right? I mean, these things are just, there isn't the liquidity there. So one of the things that I've been stressing to clients is if you believe in our roadmap, start thinking about the allocations now, because the most amount of money is made off the low. So that's why I'm looking at beyond the precious metals complex to start looking at some of these more broader commodity metrics, which are not just a debasement of the fiat money thing, but would and should start to perform, if I'm right, and we get that broadly positive risk asset environment next year. fiscal, supported by an awful lot of monetary spend, and a recovery from the COVID type situation. I think there are better things to own than precious metals, or not necessarily better things, but you should be managing that risk and rolling. I'm kind of PA. I just like, when it gets up to a certain percentage of the portfolio, I just take some of that money out and start buying what I think are cheap assets.
Brilliant. Well, thank you. That was great rundown. And obviously it's, this is, and I think it's just finished off. You think it's probably about a 10-year move now. If you've hit the structural peak in the dollar, this could be a 10-year move in the dollar, and therefore think about aligning your portfolio.
Yeah, I mean, I just think, well, at least show on the down leg, it's typically 5 to 6, but the whole cycle's 10, as you pointed out. And I just think we're in. Yes, we've seen some big moves in precious metals, and those. I was listening to Peter Brand, and I totally agree with Peter. To kind of say, well, I'm going to put all my eggs in one basket at this point and go and buy precious metals. You're a bit Johnny come lately into that trade. That's why you should definitely subscribe to Raoul and I and Macro Insiders. But the bigger picture dollar move we haven't really seen things. So you can just look at something like the CRB and look at what it did between 2002 and 2008 as the dollar dropped 30%. It rose threefold. Right. So, and it's hardly moved in big picture terms. So I think we're still in the infancy. You've got to kind of get your head around what worked in the last decade doesn't necessarily work I think quite the opposite in the coming decade. Brilliant.
Well, thank you very much for your time, Julian. It was a good conversation. Thank you. Good to hear your insights. And yeah, well, hopefully we will speak again in this series at a later date, see how it's panning out maybe later in the year.
Perfect, mate. That sounds like a plan. Have a good one. Stay safe, everyone.
I think the key element of Julian's thinking is that initially this move is primarily about US dollar weakness versus developed market currencies. The narrowing of interest rate spreads has seen the US catch down to the rest of the world, making US assets appear relatively less exciting. This could potentially see flows that left Europe after 2014, when they were chasing better yields overseas, start to return back to the Eurozone. And it's certainly the case that foreign buying of US government bonds has fallen dramatically this year. Perhaps the biggest unknown will be the reaction of other central banks. With the latest move in the euro, European equities have again started to underperform the US. A strong euro will hurt Europe's exporters and make it harder for the ECB to reach its inflation targets. The BOJ will also have one eye on the 105 level on US dollar yen. It's unlikely that they will tolerate yen strength for long, given the importance of exports to their economy too. The 100 level may be the final line in the sand. And one of the most difficult decisions will be between taking a structural view versus the cyclical gyrations that still accompany most longer-term trends in price. For instance, speculative shorts on the US dollar are at their highest level since 2011. Net speculative longs on the euro are at their highest level we've ever seen, and we can see that in this final chart. Positioning and performance are usually coincident, but we can see that when positioning has reversed from these sorts of levels in the past, the euro has reversed by as much as 20%. Over the longer term, it will be down to who has the biggest bazooka on the fiscal and monetary front: Japan, Europe, China, or the US. And you can now get the big conversations from Refinitiv as a flash update on your Alexa device or Google Assistant. And if you want to know more about how to download it to your smart speaker, please go to refinitiv.com/flash briefing.